Michael, let me start with you. I'm looking at your latest note, and you still don't seem fully convinced here. You say, as we look into the future, despite the increasingly complicated challenge in modeling these new moving pieces, and there you're referring as well, of course, to the soon-to-be-introduced ad tier, we believe the most bullish Netflix forecasters have overestimated the near-term earnings power of Netflix. So even with that 14% rise in those good numbers, you're not on board?
David, we look at where some of the people who are really bullish on the stock are, and I think they are just overestimating the benefits of these two changes, and they're ignoring the cost of currencies going the wrong way. So we would love to be more constructive here, but our first rule of thumb when it comes to stock analysis is if the street is above us, we're concerned. If we're above the street, we're really bullish. And I just keep thinking, this pivot is a lot harder than people think. It's complicated, and we've just given it a green light to think, oh, it's all going to work. The company looks positive. Let's upgrade it and off to the races. And we're, you know me pretty well. We're skeptical. We think there are challenges.
What gives you pause though about it? Because when I speak to investors, as I know you do, they do seem enthusiastic on the ad tier. The sort of the targeting for advertisers, the $65 CPM I'm hearing, the fact that they've had so much churn through the years that conceivably will now be stopped as a result of having this lower price tier. What gives you pause?
Okay, there's a couple things. And you remember last week we did a note saying, look, curb your enthusiasm. So we raised numbers. We thought this is a good pivot. There's two things that jump out at us. One is the risk of people spinning down, right? Looking at the $6.99 offer when they pay $19.99 or $15.49 and saying, I'm willing to, like people at Hulu, take ads as a way to reduce my bill. And so there's a near-term spin down on revenue per user. And then on the monetization, our challenge suggests there's a lot of enthusiasm for the launch of this product, but the prices, the CPMs they're looking to get are so above kind of where the world is. There'll be initial excitement from Madison Avenue, but longer term prices have to come down, CPMs have to come down. So we just think that, we're putting the cart before the horse here. There's so many moving pieces that just responding to, yes, it's a good idea. It's definitely a smart idea, but the math is going to take some time to be more to be accretive versus where I think the street is. We're just conservative about the speed of the improvement here.
Barton, you seem like you're conservative based on your reports here as well. I want to get your thoughts on the quarter we just saw, and also the fact that Netflix is basically changing that guidance and has told investors yesterday that they're focused on revenue as our primary top-line metric. How do you see it? How are you doing the math with all of these changes afoot?
Look, I'm thematically not different than Michael, although I think I get there in a little bit different way. The report last night was not a massive beat. They beat their sub-guidance by 1.4 million on a base of 223 million, so less than 1%. That's noise. You can't get that more precise in guiding, and so for people to get really pulled up on that, Netflix is not guiding to subs anymore, partly because they can't do it at the level that the street wants. These huge misses, and upsides reactions are really just a measure of the size of the base and the difficulty of guiding to the precision that the street wants. So they won't do that anymore. They'll talk to revenues where 1% variance is not really going to drive huge gyrations in the stock. So that's helpful. But I think that people are getting too bulled up on the read from this. As for the advertising, I think one of the problems is that Netflix is only leading with this on this basic tier with ads. It's very limited, one stream, limited HD, no ability to download. They have a basic version without ads that I think is one of their lesser popular plans. And this, I think, will be a haircut from that. The other way to do this is like Disney is doing it, where everybody's kind of get advertising by default unless you opt out and pay more. Disney, I think, has kind of trounced Netflix in eyeballs for SVOD advertising. Disney will be the better ad story, we think, in 2023 than Netflix.
So just to dig into that a little bit further, you'd buy Disney here as earnings get underway, and you feel a little more impartial to Netflix then?
Yes. I think, the streaming story at Disney is kind of inflect much more positively, particularly relative to expectations, I think, than Netflix. At Disney, we have the wild card of the recession and theme parks. But in terms of streaming, if you want streaming exposure, I think Disney's going to have a better year ahead of it than Netflix.
Yeah, Michael, let's widen out then to our usual conversation. I mean, do these numbers from Netflix say anything in terms of or change your view at all in terms of profitability and or the ability of direct-to-consumer to continue to expand?
I'm smiling, David, because when I think about this beat this quarter, it came most likely from India. And you know the Disney Plus narrative where India's been a big driver of subs, and we ignore it because the Indian ARPU is less than $1. So, I think the U.S. market and European markets are reaching maturity at these price points. And, I'm not convinced, and we'll see. I think the ad tier is a smart pivot. But to Barnes' point, you have to be all in, right? You need to do what Hulu's done, which is 2/3 of Hulu's base takes advertising. So I'm not convinced. I still think at the end of the day, this is a hard model. This is a model where you require tons of original content. You need price increases every year to kind of hit where the street is. And, the majority of the base will have price hikes anniversary next year. The question I have for Netflix is, will it be able to take price again next year? Because this year, when they took pricing up, there's a ton of churn, right? So I think we're hitting a wall on the upper limits of what people are willing to pay. So I think it's really complicated, David. I've been saying that a lot. I'm not convinced this is a great model. I've said that from day one.
You have, and we've been having that discussion. Barton, I'll end with you. When you look at the company right now in terms of its content spend, do they have the ability to potentially lower it at all to increase margins, therefore, or are they going to always have to maintain, if not continue to increase?
Yeah, look, I don't think there's any reasonable argument that they would be substantially, meaningfully reducing the $17 billion that they're planning to spend for this year, next year. I think the real question is whether there's a pivot, a step up. I mean, it's clear that we're moving towards a world where table stakes in streaming will include other things like sports, maybe news, things where Netflix is not a player. And they'd have to spend a lot, probably absorb some margin dilution to get into those things. Clearly, they're not going to do that this year, next year. But, over the longer term, you have to have that in the back of your mind that, the model's not baked. They're only playing in a portion of the TAM they're going after if they're going after TV. And at some point, there's going to be a lot of pressure to change that because everyone else is. Apple's doing it. Amazon's doing it. Paramount's doing it. I think Netflix will face pressure to do it as well.
Yeah. Barton, Michael, thanks to you both. Appreciate it.
Thanks.